Right, greetings to everyone. Um, you're all welcome to our channel, Pros and Cons Accountancy Tutorials. My name is Edward, and you can call me Ed for short. Right, so today we want to um, do something on IAS 16, which is property, plant, and equipment. What we may abbreviate it and say PPE. All right. So the issue is, what is IAS 16? And one thing I want to put out is that this is a standard related to an asset, right? And anytime you have a standard in relation to an asset, being it a PP, being it an investment property, being it intangible asset, there are some things that you need to have in mind, right? So that you'll be able to deal with whatever question that has been given to you or whatever scenario that you're dealing with. One of these is to know the definition of the assets that you're working with, the recognition criteria, the initial measurement of the asset, the subsequent measurement, as well as the subsequent expenditure, the disposal criteria, as well as lastly, we talk about the recognition. So whatever asset that you are working on, whatever standard in relation to assets that you are working on, you should have this in mind. You should have these issues in mind. And once you are able to cover these issues, then it means that whatever scenario which will be posed to you on that asset, you will be able to deal with it and make it simple for yourself. Okay. So today our focus is on one standard which is in relation to what assets, right? Named PPE or property, plant, and equipment. So the question we ask ourselves is then what is the definition of property, plant, and equipment? So when we talk about property, plant, and equipment, it's basically a tangible asset, right? Which is held and controlled by an organization for more than one accounting year. But it's not just about holding it for more than one accounting year. They should be using it in what? In generating income. So in this case, IAS 16 is talking about three uses of what? This asset. And the three uses of the asset is for the production or rendering of service. That is one. Two, for rental to others. That is two. And then three is for administrative purpose. So a tangible asset that we are holding and controlling for more than one accounting year, which is used for what? Which may be used for production of goods and services, for administrative purpose, or rental to others. So it shouldn't be an asset that is with you and it's just there idle. No, it's not something that you are going to abandon it. It should be in use. So basically, that is the definition for IAS 16, property, plant, and equipment. So if we should put something down in terms of the definition, then we are saying that tangible asset held and controlled by an organization for more than one accounting year, right? For more than one accounting year, for more than one accounting year. And what are the uses? So the uses, they're saying that it should be used for production and or rendering of services. It can also be used for administrative purpose. Administrative purpose, and also maybe rental to others. Rental to others. So if it is PPE, then this is the definition for PPE. Actually, this issue be used for either production and rendering of services, administrative purpose, and rental to others. So this is the definition of PPE. Now we know the definition. Then what is the recognition criteria? The recognition criteria itself comes out from this definition, right? So the recognition criteria is that it should be able to accrue income or generate income to the entity or to the organization, right? And one other recognition criteria is that we should be able to measure it, right? So the reliable measurement of the cost, we should be able to measure it, but reliably. And that is also one recognition. So the recognition criteria is just two. Recognition criteria. So the recognition criteria is talking about cost being measured. The cost should be measured what? Let's say cost can be measured reliably. And also, we are talking about the fact that it should be able to accrue income or generate income to us, the entity, inflow to the entity. So probable that economic benefit flow from it to the entity. So we are talking about it is probable that economic benefits will flow from the assets, from the assets to the entity, So if you have just abandoned it, then it means we can't recognize it as what? As PPE. So that is the idea for the definition and the recognition criteria. Now, in terms of PPE or in terms of assets, because it is something that we are using in our company, and we are also going to recognize it or use it in our financial statement as something which belongs to us, then we will have to measure it. And that is why one of the recognition criteria is saying that cost can be what? Reliably measured. So if you can't measure it, then it means we can't recognize it in our financial statement. So then, how do we measure the PPE? How do we measure property, plant, and equipment? So let's deal with what? The initial measurement of property, plant, and equipment. Now, under PPE, the initial measurement takes into consideration three things, three issues, and one of the issue is the purchase price. So if I go to the market and I go and purchase, let's say, chair, the purchase price of it is what we are talking about. So one is the purchase price. One is the purchase price. It may not be chair. I may go to the market to buy machine, a high standard machine that I'm coming to use for production, right? So yes, the purchase price is part of what the initial measurement. Now, we said three, so it's left with two. What is the second thing? One other thing is that there may be some other cost, attributable cost, leading me to let this be able to install this machine for it to work. So some of these attributable costs, we may have installation cost, even transportation cost may be part, right? So any other cost which is associated in getting this asset useful for it to be used is what we are talking about. So any other cost, maybe when you are bringing it, you may pay stamp duties. You may be paying some legal fees for transferring of the asset to your side. So whatever attributable cost which led you in getting this asset to be used is what we call the attributable cost. So attributable cost, any attributable cost. You may even pay some taxes here and there. They are all attributable cost. Okay, but what we should know is that these attributable costs should be linked to the asset, meaning if not the purchase of the asset, you will not incur those costs. So that's why we call it what? Attributable, traceable to the purchase. The last cost is what we call dismantling cost. Dismantling cost or site restoration. Site restoration cost. Now, if let's say you have a company, you purchase an asset, install it at your site. So the installation cost is part of attributable cost, isn't it? You install it at your site. If you decide not to do that, not to perform the work again, you have to what? You have to make sure you take whatever you installed at the place from there so that you can level the land. So that's why we call a dismantling or site restore. We restore the site back to how you met it. So normally we talk about these say people, and you say that even if they finish and they are going to restore the place to how they came to meet it, like it would have been okay, but that's something that they do not do. And in fact, this issue is for another level, so I wouldn't want to talk much about it, right? So the issue is after using the asset to the end of its useful life, or when you decide not to use it again, you will not leave it there like that. If let's say you use it to the end of its useful life, so it's no more useful, you are not going to use it again, and it cannot be used again. You can't leave it there. You have to take it out so that you level the ground. Maybe you may even want to install another thing there. So even the cost of you taking the asset out, that is what we call the dismantling cost or site restoration cost. So your initial measurement of PPE is going to take into consideration the purchase price or attributable cost, and then what? Dismantling cost or what we call site restoration cost. Then we should know that then this cost is a future cost. It's a future what? Cost. Because if we talk about dismantling cost, I will not know the dismantling cost today. It is a cost which will happen in future, right? So normally, if we have a question which has the dismantling cost, we will have to bring it back to what? To the present so that we will know the amount today. So for the purchase price, yes, you get it today. Attributable cost that you are things that you are paying in relation to whatever purchase that you made, that one too you get to know. But the dismantling cost is a future cost. So it is more or less a provision that we'll be making or an estimate that will be done. Right. So if the estimate is given to us, we do what? We find the present value so that we get to know its amount what today. So surely if we will solve a scenario. So if we have a scenario, you will see that the dismantling cost, we are going to bring it to the present. The site restoration cost, we will bring it to, because it's a cost we will incur in future. So if you want it today, then we have to get what? Its present value today. That is basically on the initial measurement of a PP. Initial measurement of a PP. Now let's look at the next one, which is the subsequent measurement. Subsequent measurement. Subsequent measurement. So with the subsequent measurement, PPE has two models that it uses for subsequent measurements. And the models are cash model and the revaluation model. Cash model is so simple because when we talk about the cash model, sorry, I said cash model, cost model. So when we talk about the cost model, it's simply you valuing the asset or recognizing the asset at the initial cost, like this cost that we had. You revalue it at what? The initial cost, right? Then we less any depreciation as well as impairment. We dealt with IAS 36 the last time. So impairment in natural form is what? IAS 36, right there. Wear and tear, which may be as a result of depreciation too, you have to also take it up. So the cost model is just valuing the asset at its cost, initial cost. Then you take out what? Any accumulated depreciation and impairment. Any accumulated depreciation and impairment. So basically, that is the cost model. So cost model is talking about the cost, initial cost, less what? Depreciation. Then you also less impairment. And you remember we've done impairment in our earlier videos. So please, if let's say you've not seen impairment or you don't understand impairment, then I'll advise you watch our earlier videos to get more understanding impairment. In fact, IAS 30, IAS 16 goes with what? IAS 16. So it will be better we understand IAS 36 so that we can deal with it under the concept of what? IAS 16 as well. All right. So what about the revaluation model? And this has been the model where students or even professionals sometimes has challenges because of um, uh, the things that we have under it. Having a revaluation at the beginning of the year, middle of the year, end of the year, the revaluation gains, revaluation losses, how to even treat them becomes another issue where you may even get excess depreciation and the rest. So there's a lot of issues under the revaluation model, unlike the cost model, which is so simple, recognizing it at initial cost, less accumulated depreciation and impairment, if any. Now, when we talk about the revaluation model, the revaluation model is whereby an asset is in use. Let's say you're using an asset, then it gets to a point you want to check the asset and see if the value of the assets is the same as you are keeping, or you think it should be revalued. Right? So an organization will be using their assets and will say that no, you want to revalue this our asset. So you call for a valuer to come and revalue the asset for us. It is possible the asset will be revalued up or it will be what? Revalued down. Right? It is possible it will be revalued up or it will be revalued down. Once the cost or the current amount can be revalued up and down, it means its useful life can also be revalued what? Up or down, or remain the same. Or remains what? Remains the same. What we really have to take into consideration more is the depreciation when there's what? The depreciation when there's revaluation. Depreciation when there's what? Revaluation. So here we will be talking about revalued amounts. In any case, we will also be talking about depreciation, right? Depreciation. Then we also still be talking about impairments because you may have even let's say you brought in a valuer who has come to value it. However, how you were keeping it in your looks is higher than what the valuer is saying, it means the asset surely has been impaired. But in this case, we call it what? Revaluation loss. A revaluation what? Loss. So with a revaluation, we are going to get either a revaluation loss or we can also get what? A revaluation gain. So let me put it as revaluation revaluation loss or gain. We may also have change in useful life. The change in what? Useful life. Talking about the change in useful life, where you are using an asset which originally had 10 years. The useful life was 10 years. So let's say you've used the asset for 2 years. So to you, it's left with just what? It's left with 8 more years. Then after revaluation, the valuer told you that no, this asset, looking at how it is, we should increase the 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 useful life which is left. So the valuer said the useful life should now be 12 years. So it means there has been an increase in the useful life. There has been an increase in the useful life. So there may be change, either reduce the useful life or increase what? The useful life. So these are some of the issues we are going to talk about under revaluation model. So revaluation model 2, you get your revalued amount, you subtract what? Your depreciation. You subtract your depreciation. Okay. Now, if we were using, let's say, the cost. So we have the cost, we've taken out our depreciation, then revaluation came in. So after the revaluation came in, we decided to what now compare the current amount that we have with what the revalued amount. So that is what is going to give us the revaluation loss or the revaluation gain. Let's put all these things aside. Revaluation may be done at the beginning of the year, it may be done in the middle of the year, or it may be done at the end of the year. Surely we may solve some scenarios of that. So it may be done at the beginning of the year. So now, what does it mean if revaluation is done at the beginning of the year? Okay, so let's say before the start of the year, I had a carrying amount of 10,000. Had a current amount of 10,000. Then that same day, the asset was revalued. The asset was revalued to, let's say, 15,000. And the useful life remained at what, 10 years. Okay. So in any case, I should have depreciated this 10,000 using what, 10 years. But there's a revalued amount from the beginning of the year. So I can't continue using this. The asset now has to be recognized at what, 15,000 instead of what? Instead of the 10,000. So you can see that there's a difference between the 10,000 and the 15,000 or 5,000. So that's what we call a revaluation gain. A revaluation gain. So that 5,000 is a revaluation gain. So going forward, this is, let's say, at January. They are all at what? January. So going forward to December, it is the 15,000 I'm going to recognize, not the 10,000. So if I want to calculate for depreciation, because the revaluation happened at the beginning of the year, if I want to calculate for depreciation, then it is going to be the 15,000 divided by 10 years. And then 15,000 divided by 10 is going to give me 1,500. So at the end of the year, the carrying amount at the end of the year is going to be 15,000 minus 1,500, which will give me 13,500. So this will be the carrying amount in your what? In your financial position. So this will go to your financial position. But this is depreciation and we'll go to what, the P or L. To go to the P or L. So basically, this is revaluation at the beginning of the year. Revaluation at the beginning of the year. Right. Let's look at revaluation in the middle of the year. So here we talked about beginning, middle of the year. So revaluation, we're talking about middle of the year. So when we say middle of the year, it can be at any time. Let's say 3 months, 6 months, 4 months, or so. So here, same way, let's say we had a carrying amount of 10,000 again, right? And this 10,000 was as at 1st January, was as at 1st January. And then revaluation came in as at 30th June of 15,000. 30th June of 15,000. So now the question you ask yourself, okay, let's bring the useful life of 10 years. So the question we ask ourselves is, which of these are we going to calculate the depreciation of? Because this is uh, 6 months, then revaluation also came in. Which one do I use? That is where you begin to panic, right? But the first 6 months, you didn't know of this 15,000. You knew of this 10,000, but you didn't know of this 15,000. It was after the 6 months you got to know that, okay, a revalued amount has come into the what? 15,000. So what do we do? Then it means our depreciation for the first 6 months, right? Depreciation for the first 6 months will be on what? Will be on the 10,000. So we are going to get 10,000 divided by what? 10 years times 6 over 12. So 10,000 divided by 10 years times 6 divided by 12. So that gives us 500. 500. And the year is not just 6 months, it's 12 months. So what about the rest of the 12 months? The rest 6 months. So it means the rest 6 months will be on what? Will be on the 15,000. So depreciation next 6 months. So the next 6 months, remember we allow it 9.5 years. It's no more 10 years. It is 9.5 years, right? So the rest 6 months will be what? 15,000 divided by 9.5 years times 6 over 12 times 6 over 12. So 15,000 divided by 9.5 times 6 divided by 12, giving me 789. So 789. So total depreciation will be the first 6 months, which is 500, plus the last 6 months, 789. That is 1289. 1289. So what then becomes the carrying amount of the asset? You have to be careful. For the year, total depreciation is this, which will go to P or L. This 10,000 is no more in use. It is this 15,000 we are using. And ever since this 15,000 came in, we have only calculated depreciation for just 6 months, which is this. And this is what we are going, the 15,000 is what we are going to recognize. So how much is going to be the carrying amount? For the 15,000, it can only take a depreciation of about 789. And that's what we are recognizing. So it means our carrying amount will be equal to the 15,000 minus 789. The 15,000 minus what 780. So 15,000 less 789 is going to give us 14,211. And that is going to be our carrying amount, which will be recognized in our financial position recognized in our financial position. So this is depreciation, revaluation at the middle of the year. What about end of the year? End of year. Revaluation end of year. So when we talk about revaluation end of year, let's use the same scenario where our carrying amount is 10,000. We have revalued amount of how much? Revalued amount is still 15,000. And our useful life is 10 years again. So this came in end of year. We didn't know it. It came in end of year. So we have been using 10,000 throughout. So what does that mean? It means our depreciation will be on the 10,000 from the beginning to the end of the year. Because the 15,000 we didn't know from the beginning till the end of the year. So by end of year, it is the 10,000 we were using. And we have to charge our depreciation on the 10,000. So depreciation is going to be 10,000 divided by 10 years. 10,000 divided by 10 years. And that will give us 1,000. That will give us 1,000. So in any case, our carrying amount, we are seeing our carrying amount to be 10,000 minus what? 1,000. And that should have been what? 9,000. Recognizing our financial position. But revalued amount came in. Revaluation what came in at the end of the year as what? 15,000. So this is what we are going to recognize in our financial position without any depreciation on it. Without any depreciation on it because we've not used it. Right. Then our revaluation gain will now be what? This 15,000 minus the 9,000 to give us 6,000. So our revaluation gain is 6,000, which will go to the OCI and subsequently to your financial position. Let's look at when it was in the middle of the year. When it was in the middle of the year, look at what happened. We had 10,000, right? This 10,000 was charged a depreciation of 500. So it came to 9,500 before we continue with the 15,000. So it means there's a certain revaluation gain as at the time the revaluation amount came in. And how much was that? It was 15,000. And the carrying amount as at the 6th month was 9,500. So it means the revaluation gain will be 15,000 less what? 9,500. And that would be 5,500. When it was at the beginning of the year, we calculated it when it came in. So the beginning of the year, the revaluation gain was what? 5,000. So what I want you to understand is that when we talk about revaluation gain loss, it is when it happens. Anytime you see revaluation amount or the asset has been revalued, go and calculate the revaluation loss or gain there. So it means if it's at the middle of the year, calculate the depreciation as on the figure you were using to get your carrying amount. Then you compare with the revalued amount to get the revaluation gain or loss. Don't wait till the end of the year. No. If it is at the end of the year, then that's it. It means you would have calculated depreciation on the value you were using to the end of the year before you calculate for your revaluation gain. If it's at the beginning of the year, once it came in, you compare with the current amount over there to get your revaluation gain or loss. If it's at the middle of the year, the amounts that you've used on the initial amount, calculate depreciation there and then compare with what? The revalued amount. As at that time to get your revaluation gain or loss. So that is the idea of revaluation. That's the idea of revaluation. But that isn't all. Today, I want us to talk about the revaluation so that the next time we meet, we will deal with the other issues, talking about our subsequent expenditure, the disposal and the disposal issues. Then we have some scenarios, we'll solve those scenarios before we can close the chapter on IAS 16. So Surely we may have about one or two meetings more to deal with the scenarios. So today, let us finish the issues and understand the issues on what revaluation, right? Okay. So now we've gotten to know revaluation at the beginning, revaluation at the middle, and the revaluation of what at the end of the year. At the end of the year. Now, revaluation does not end there, right? So if let's say we have a revalued amount, and at the end of the day, we got to know that okay, there was a revaluation loss or a revaluation gain, right? So we have something like saying first time revaluation, first time revaluation. So you know that first time revaluation will actually bring a gain or a loss. In fact, revaluation gain should go to where OCR, and revaluation loss should go to where the profit or loss. That should be the idea, right? That should be the idea. Okay. Now, first time we've gotten a revaluation gain. First time we've gotten a gain. So we are saying that gain should go to where OCR. If the first time it was a loss, then that loss go to P or L. That loss go to where P or L. That's first time. Okay. Let's do it the second time. So the second time you did a revaluation again, and let's say you got a gain. You got a gain. Let's associate this with the first time what gain. So if first time you got a gain and second time you are getting a gain, then it means this gain should also go to where OCR. This gain should also go to OCR. So it will go and add up to whatever we have at OCR. That's first time gain, second time gain. First time gain, second time gain. Right? Good. What about first time gain, second time loss? First time gain, second time loss. So let me do it well here for you so that it does not become an issue. So first time gain, second time also gain. So all goes to where? OCR. All the gains goes to OCR. Go to the other comprehensive what? Income. Okay. What about first time loss? Loss. First time loss. Second time gain. First time loss, second time gain. So if the first time you made a loss, but second time you made a gain, surely you know that the loss will go to where? The first time loss will go to your POL. But the second time gain should have go to OCR. And we are saying that the second time gain should go and offset that loss we had in the POL. It should go to the POL to go and offset the loss, so that if the gain is more than the loss, whatever will be left, we bring it at the OCR. Bring it at the OCR. So the gain in second time should what? Should offset the loss in POL for the first time. For the first time. Any excess should be what? Should be recognized at OCR. OCR. That is, if the gain is more than the loss, then any excess should be recognized at what? OCR. But if the gain is less than the loss, then just offset it. Whatever is there should be there. So it means the next time, if let's say the third time, you get a gain again, it should go and offset the remainder of the loss in the POL. Then the rest, if it is more, then the rest can come to where we can recognize the rest or the remainder at the OCR. So that is the idea of what? Revaluation, gain and loss. So if let's say the first time you made a loss or you made a gain, that gain surely will go to what? OCI. But the second time you made a loss, where do you think it will go? That loss has to go and offset what? It has to go and offset the gain at the OCI to the extent that it will be able to what? Cover all. If it's unable to cover all, we do not leave loss at OCI. No, the remainder of the loss should come to the POL. Under no circumstance are we going to leave revaluation loss at OCI. No, it doesn't happen like that. The only asset for which we can leave its loss at OCI is financial instrument. Financial instrument. Something we'll be dealing with as time goes on. So this is the idea of revaluation. This is the idea of revaluation. As I said, as time goes on, we'll be talking about all the issues one by one. Today, the focus is to understand revaluation. So that if we start with scenarios, you'll be able to get it. But before we go on, let's look at some scenario for on the initial measurement and also the let's see if we can get those. We can get some scenario on the initial measurement. Initial measurement. Okay. Okay. So this is a scenario on the initial measurement. Illustration 1. Now, Cons started construction of an oil rig for its own use on 1st January 2024. During the year, the company incurred the following costs. We have the purchase price, which is 250,000. They purchased a land for that. So they had it for 250,000. There was a stamp duty, there was a legal fees, there's site preparation and clearance. Remember, this is site preparation, not site restoration. Right? This is site preparation and clearance, which is 18,000. Materials of 100,000, labor 150,000, architect's fee 20,000, and general overhead. These are general overhead. When we talk about general overheads, we don't add it to the initial because with the asset or without the assets, general overheads in an organization will still happen. Right? General overheads in an organization will still happen. So we do not add general overheads to the initial cost of a PPE. So that will not be here. So additional information is that materials costing 10,000 were spoiled and wasted. So it means that material 10,000 cannot be charged to this. It cannot be part. It's not attributable to it. It's something which was wasted. So it was not actually part of the cost. So if we have materials, we will have to take out 10,000 from it. So the materials will now be 90,000 instead of the 100,000. Let's go on. Works on the project was suspended for 2 weeks in October 2024 because of the spoilage. Approximately 9,000 of the labor cost relates to the suspension. So if there was a suspension and 9,000 relates to that labor cost, it means it can be part of what is not directly attributable to the asset. No. So this labor that we will have to take 9,000 out of it and make it 141 instead. 141 instead, right? So what does that mean? They said we should calculate the cost of the oil rig that will be included in tangible non-current assets. So it means if we are doing that, the purchase price will be there. What are the attributable costs? We have stamp duties, we have legal fees, we have site preparation, we have materials, which is supposed to be 90,000. We are having labor, which we will take 9,000 out from it to make it 141,000. We have architect fees, and then the general overheads, we said it is general, and therefore we will not be adding it. So let's try and add these together. 250,000 plus 5,000 plus 10,000 plus 18,000 plus 100,000. But this 100,000, we will take 10,000 out from it. So minus 10,000. Then plus 20,000. Then we add the 150,000, which is the labor, where we are going to also less 9,000. So in all, we are getting 534,000 instead of the 583,000, which has been given to us. So this is the initial measurement. Remember, this one didn't feature what? Site restoration. We do not have site restoration in this one. So let's see if there's any other one which is going to give us site restoration. Now, let's look at illustration 2. Atiku bought a building on 1st January 2019. The purchase price was 29,000. The associated legal fee were 1,000, and general administrative costs allocated to the purchase were what? 2,000. This is general. So the moment you see the word general, then it means you don't touch it, right? It is something general. They are trying to what? Just associate some with the purchase. No. Once it's general, we are not going to touch it. Okay. Atiko also paid sales tax of what? 5,000, which was recovered from the tax authorities. The building was attributed to a useful economic life of what? 50 years, right? You have to determine the initial cost of the building, the depreciation to be charged in each respective year, and the net book what? Value accordingly. Now, I believe by now, by this time, we may know more about depreciation, isn't it? So this question, what they are trying to access is that you are buying a certain property, right? And that property that you are buying, the cost of the property is how much? The cost of the property was given to the article. Where's article? Yeah, you bought it at 29,000. So the purchase price is 29,000. And then there was some legal fee. So the attributable cost, we have legal fee. And that legal fee is 1,000. And then also we have administrative cost. This is administrative, so it will not come in. So the admin, general, it is general. General admin will remain what? 0. The general admin will not come. And also article paid sales tax. But they are saying that this sales tax, you recovered it. You were able to recover what the sales tax. So if you recovered it, then it means it is not associated to what? To the project or to the asset. So it means our asset, the cost, the initial cost will be what? 30,000. 30,000. So we can bring the sales tax, which was 5,000, but recovery also of 5,000, which brings the whole thing to what? 30,000. So initial cost is 30,000. And you were attributable, it was attributed how many years? Attributed to 50 years. So we can use the 50 years to depreciate this asset. Now, what you have to know is when we talk about depreciation, you may be using a straight line method, a straight line, or the reducing balance. Right? This is dealing with what? A straight line method, because we're just giving what? 50 years. If it were a reducing balance, you would have been given maybe a percentage to be used, right? But how do we calculate for depreciation? Depreciation is basically the cost of the asset less residual value. Then we divide by useful life. Useful life. That is the straight line. If it was to be reducing balance, it will just be a percentage. You multiply the percentage by what? The cost. And that will be all. Then reduce it. The next year, we'll use the reducing balance to continue to calculate. We'll calculate the percentage on that reducing balance. So if you look at this one, it's a straight line method. So our depreciation will be equal to the cost, which is 30,000, minus a reducing residual value, which is 0. The question didn't give us a residual value, but it gave us a useful life of how much? 50 years. So that will be 30,000 divided by 50, giving us 600. So the current amount is now going to be at 30,000 minus 600. That will give us 29,400. 29,400. So this is the current amount, the depreciation, and the initial cost of this asset, of the asset article. Right. I wanted to see if we can get a scenario with, okay, so let's look at this one. Scenario 3. Good. Scenario 2, that is continuation, right? Okay. An asset costs 10,000 at the end of its 20 years useful life. It will cost, so at the end of its 20 years useful life, it will cost 4,000 to dismantle and remove. Good. If the discount rate is 5% per annum, calculate the present value of the dismantling cost to be added to the initial cost of the asset, right? So this one, you have the initial cost, which has been given to you. The cost is 10,000, and they are saying that it will have a dismantle value of 4,000, which is in 20 years' time. So we have to bring this to the present using 20 years. So let's go to the board. Let's go to our board. So illustration 2 again. We have an asset, and the cost of that asset is 10,000. That's the initial cost of 10,000. Or let me say the purchase price is 10,000. Now we need to add dismantling. So let's say this 10,000 is as a result of what? The purchase price plus attributable cost plus other attributable cost. So we need to get the dismantling cost. And it's the dismantling cost that is given to us to 4,000. But this 4,000 is 20 years' time. How do we bring it to the present? We have to bring this to the present because it's 20 years' time. So let's bring it to the present. Now, if in bringing it to the present, we will need a discounting factor. And they have given us a factor of 5%. A factor of 5%. If we are bringing something to the present, the factor to use is 1 over 1 plus r raised to the power n. And the n is the useful life. N is the life of the asset, right? Here, we can also decide to use 1 plus r raised to the power negative n. Is the same. This 2 is the same. This 2 is the same. Good. Now we know our r to be equal to 5%. And then n is equal to 20 years. So how do we bring this to the present? And our cost, the dismantling cost that we are bringing to the present is 4,000. So we will have 1 over 1 plus 0.05 raised to the power 20 times 4,000. And what do we get? 1 divided by 1.05 raised to the power 20 times 4,000. And that is giving me 1507.56. So 1507.56 6. So our dismantling cost is 1507.16. So if we add to the 10,000, we get 11507.56. But please, whenever you bring something to the present, it should have two legs because it is a future cost bringing to the present. That's a present value. And it is a liability because it's something we pay in the future. There's a liability, right? So it will be part of the asset though, but we also have to capture it as what? A liability. So this will have an asset and what? A liability component. We'll have an asset and a liability component. So if let's say we should go to our financial position, we go to our financial position, we are going to have the asset, which is 11,507.56. 11,507.56. And we also have a liability, which we may say a provision, right? And that is as a result of site restoration or dismantling cost. It is 1,507.56. But if you bring something to the present, then surely you are going to finance it. So there should be a finance cost as well. There should be a finance cost as well. And anytime you bring something to the present, the finance cost is the percentage which were given to you on that amount. You calculate. So here it was 5%. So we are going to have an accrued interest. That accrued interest is what will help us to finance this so that at the end of the 20 years, we will get what? The 4,000 for them. So there's going to be also an accrued interest of 0.05 times what? 1507.56. That is how much? 1507.56 times 0.05, giving us 75.38. 75.38. So you can see that in effect, the total liability is 75.38 plus what? 1507.56. But for that year, it will give it 1582.9. So let me say 1583. That is for that year. The next year, we will calculate another 5% of 1583 and add up again till we get to the 20th year. So by the time you get to the 20th year, you see that the accumulation, we have accumulated up to what? 4,000 Ghana cedis because we brought it to the present, which was from 4,000 to where? 1,500. So we have to do what? Financing it small. And this finance cost, this is a liability. It's also what? A liability. But because it's a finance cost, it will also go to what? Our profit or loss. It's a finance cost, so it will go to the profit or loss. This is where we will end our session for today. God willing, we will deal with the other scenarios and also explain the other issues that we have in terms of our subsequent expenditure, the disposal, and likely the recognition criteria. So thank you very much for joining us. Please kindly subscribe to our page, like it, and share with others if you find it interesting. We will do our best to make sure we give you more content and more scenarios like this to boost up your knowledge of accounting and taxes and finance and any issue which may come up. Thank you very much for joining. My name is still Edward, and you can call me Ed for short. Bye-bye.